On December 4th, 2018, the 2-year yield rose above the 5-year yield in Treasury bonds, which is a yield curve inversion. Of course, Wall Street poo-pooed it, but we've got a bigger indicator that is flashing red. And we're going to talk about that coming up. I'm Lynette Zang, and welcome to ITM Trading, a full-service physical precious metals brokerage house specializing in developing strategies based on your individual personal goals so that you can thrive through the reset that, quite honestly, has already begun. So today we need to talk about the current warning signal that is flashing red. And the question is, does that indicate an imminent crisis? Or when will that crisis occur? Which, of course, is the question that everybody wants. Now, we do know that once the markets hit a bottom on December 24th, because the Federal Reserve was raising rates and reducing their balance sheet, well, the markets were imploding, so the Federal Reserve and all of the other global central banks, frankly, did a pivot. That created that V-shaped formation, but V formations in the markets are actually quite vulnerable. What goes down and up fast can go down fast again. And that's exactly where we are right now, with the markets really falling apart. Why? Well, they can give lots and lots of reasons for it, because there are a lot of reasons for it. But the fact that the punch bowl is not going to be taken away, well, that's what gave you that V to begin with. President Trump indicated that there's no immediate reduction in tariffs. And what does that really do? That increases costs for corporations. At the same time that you have this global slowdown that is really becoming apparent to the public, which lowers income. And with debt levels at mountainous levels and all subject to that interest rate risk, well, what do we have? We have a global slowdown on a mass basis. Europe, Japan, the US, China. We've got the Brexit we're going to be talking about this week. And so, much as Wall Street says that this time is always different, the yield curve has been inverted since December 4th, and now that inversion has widened. Now, interest is supposed to indicate the value of money over time. So if you loan somebody money for, say, 10 years, then you're typically going to want more interest to compensate for the loss in purchasing power or compensate for the loss of use over the money for that length of time. But in a yield curve inversion, the short rates are higher than the longer rates, which means you get paid more to loan money on a short-term basis than you do. So now 3 months, or frankly, even overnight. Today, the 10-year Treasury yield at 240 was exactly the same rate as the overnight rate from the Federal Reserve. That makes cash king, quite honestly. But that tells you that the value of money in the future, it's not as high as it is right now. Well, of course, we know that through inflation, but now it's flashing red for everybody. In addition, the 3-month to the 10-year, because the 2 and 5 wasn't enough, but the 3 month to the 10-year has been in many people's opinion, the most consistent predictor. So the gray bars are official recessions, and you can see where the 3-month to 10-year yield, that's what this graph is showing you, dropped below that line, which means it inverted in 89, in 2000, in 2006, and now it just did it in 2019. We are in for not just a recession, because in the past, when we've hit a recession, what have the central banks done? They have dropped interest rates and injected money into the system to stimulate the economy, which of course, as we see from the monetary velocity chart that I did last week, it has not really been working anyway. Well, if you've got interest rates anchored at 0, where do you go from here? You go negative. And not only did they pivot on that, but they're saying that, and Janet Yellen and many are actually calling for the Fed to lower the rates now. Well, they barely have any ammo in their toolbox to begin with. So they're probably going to wait until they really, really need it, but it isn't going to work. It's too little, too late. And I just wanted to point out, they always say this time is different. That is a typical pattern that happens before the crash. So in 2005, when the yield curve inverted, was it different that time? No, they want you to think so. And listen to this. The economy is resilient. Isn't that what we're hearing now? Well, maybe it's a little challenging everywhere else, but that U.S. economy is growing strong. It's good. And also, Christmas sales were fine. The consumer is fine. The consumer continues to consume. So therefore, this time is different. Well, quite honestly, it wasn't different then or before that or before that or before that. And it's not any different this time, except for the fact that there's a whole lot more debt on the books and there's no room to lower interest rates to inspire borrowing unless you, of course, pay people to borrow. That's what negative rates are about. And you can see how the yield curve shifted over time to go into inversion. Here you go, 521, so not even a year ago, you had lower rates, shorter term bonds paying less interest than your longer term bonds. We talked about the flattening yield curve. This is just reflecting the 3-month and the 10-year, not the 2s and 5s. But you can see where the yield curve flattened. You talked about that. And now we can see how it's inverted. So you're better off staying here in the short term than you are going out, because guess what? Money isn't going to be worth as much. Shocker. Except that we're trained to think that those dollars have value, or the euros or the yen or wherever you are in this world, that fiat money, that government declared money has value. You need to keep in mind that by design, number one, of course, inflation removes that value over time, but who gets to use it first? And what are these indicators telling us? They're telling us that something really, really nasty this way comes. And if you think about the flood of the unicorn IPOs that we talked about, and I got to do a follow-up on that because that flood has begun, that too is another indicator of how close we are to a crisis. Now, one of my very brilliant strategy specialists here pointed something out to me, and I wanted to bring it up because you know what? He was right. I've been talking about melt-up, but melt-up implies a rush of buying. And we do know, because we've talked about it quite a bit here, that buyer base in stocks and bonds and all of these fiat products has been shrinking. So that now as you have all these IPOs coming to market, they got to work with the money that's already in the system. New money is not coming in. So this creates really the problem. And what he pointed out to me, and he's right, this is not a melt up yet. This is a bear market trap where the markets want you to feel comfortable so that you leave your wealth in there while all of these IPOs that are coming to market, most of which have growing losses and admittedly may never have any earnings, and somehow they're worth multiple billions of dollars. they're taking that money off the table and they're selling it to you if you're sitting in mutual funds, pension funds, those kinds of things. There are some restrictions. We're going to talk more about that probably next week. But keep in mind, these are all indicators of a very close crash. And what nobody knows is, are the central banks, are they out of tools? Because what they want you to think is that all the Fed has to do, all the central bankers have to do, is stop raising rates and stop reducing their balance sheets. And then somehow magically, everything is going to be just fine. And so you had that bam, abrupt shift from the Federal Reserve. But the reality is that there's nothing that's going to stop this because they're out of tools and they're losing control. They want you to think that the real risk would be if they kept tightening, but the real risk is loss in confidence. Because even though the public is not adding new money into the system, they're not taking the money they've already put in there out. We've been taught that there's no other alternative. There are other alternatives. Physical gold and silver, physical assets outside of the system are a fabulous alternative to this severely overvalued market. And you got to look at this trend that, boy, right on that trend line, they abruptly stopped raising rates. That is telling you something. That is telling you that they can't. That is revealing the truth that the system died in 2008. So all this QE free money, all it did was hide the garbage. It didn't resolve any of the issues. So that when they tried to take the punch bowl away, the markets are imploding. And if the markets start to implode in a serious way, like we saw in December, what happens? They ride in on their white horse to rescue. But that's the problem there. Because confidence by the sophisticated players in this market is already waning. They don't think, this is Mark Zandi from Moody's. And Moody's is the company that grades all of these bonds. And we know that they've also changed a lot of their parameters where things that would have been downgraded are not. And even they do not trust the central bank's ability to bail out the next crisis because they have nothing left. Insanity is doing the same thing and expecting different results. That's what they're all doing. And so before, where the markets were expecting no rate cuts, and really what they wanted was just keep those rates the same. And there were a little bit, maybe one rate cut. A month later, March 22nd, they've got rate cuts put in all over the place, up to 3 for this year. What does that tell you? That tells you crisis. That's what that tells you. If they cut the rates once, that tells you crisis. If they cut it twice, if they were actually cut the rates 3 times this year, and if a crisis ensues, they absolutely will. Now we're negative. And in the meantime, what have you got? Spot gold, which is a fiat money product designed to keep you away from gold. Well, that cup formation is coming to conclusion. You can see it there. So where the confidence is waning in the central banks, in the smart money, because that's who creates that formation, confidence is gaining. And we know certainly central banks have been accumulating gold like crazy, way bigger year over year. So the choice is yours. While the powers that be want you to think that bonds, which are debt, and we have a debt problem, are a safe haven asset. Or even that stocks and the markets and holding your wealth inside of the system is such a safe thing to do. What do you think the true safe haven is? Here, this is what I did today. What are you going to do today? It's up to you. You have to do whatever you're comfortable with. Personally, I see what's happening. I did a video a while ago on just before the crash. If you haven't seen it, go back and take a look at it. I'm going to look at it because I did that when there were some indicators flashing, but not as many as there are now. So I'm going to do an update on that one as well, so you can see all the flashing. People always ask me, well, when am I going to know? Please know now. Please know now. Because if you don't know now, it very well could be too late when you realize it later. The time to get ready for any crisis is before the crisis occurs. Or I shouldn't say that, because a crisis is already occurring, before it becomes visible to you and you lose all your choices. Keep in mind, shields are made of metal, not paper, not promises, not manipulations. Not because they can change accounting rules and now suddenly you're so safe, or they can change their minds and now suddenly we're all so safe. It doesn't work like that. So tomorrow we're going to talk about the Brexit, because that's looming large and we need to understand the potential impact of that. I know we've talked about it before. We'll get more detail tomorrow. So until then, please, please be safe out there. And I'll see you. Bye-bye.